The broadcast is now starting. All attendees
Well,
are
good
in
evening,
listen-only
ladies and
mode.
gentlemen, and thank you very much for being with me this evening. My name is John Needham. I'll be your host for today. In fact, I'm your host for every day, God willing. And wonderful to have you all here, folks. Peter, thank you very much. He's on the ball. Haven't seen you for a while, my friend. Glad to have you with us, and I'm glad you can hear me. Everything sounds well. And David, of course. Yeah, thank you, Lockie. Wonderful to hear. I'm going to talk about that issue you raised with me, which is about prop firms. And I'll got a little pencil note of that. I'll try and remember to do that. Thanks, my friend. Okay, so what now for equities? Well, what now indeed? And on Friday of last week, we had a Danielcode T.03 and Blue line sell signals for the S&P and NASDAQ, and we added a daily sell signal to the Russell to make sure whatever you were looking at, you got short for Friday. And we had a wonderful day, nice big down day. We don't see many of them. We haven't seen many of them in equities for a very long time, in fact. That was nice. And the question I was pondering on the weekend, as no doubt you all were, was what now for equities? And really, I have to tell you that as we reach now Thursday night and look forward to the last day of trading for this week, tomorrow, we haven't got any real clarity. In fact, the market's done a wonderful job of hiding whatever its intentions are. And markets essentially have two main jobs. The first job is to get the vast majority wrong. That's a necessity for markets. And the second thing is for it to be obscure, not to be open about what its intentions are. And remember that everything we do in all markets we are doing on the basis of probabilities. There are no certainties in markets any more than there are certainties in life. But sometimes the probabilities get very high indeed. And probabilities for a high in equities are very high indeed. Let's see if we can glean a little more information and think about the background of what this market's facing. So let's move along. Here we are. We know that markets are rational, orderly, and sometimes predictable. And of course, I think we're probably in one of those times now. And I think the balance of probabilities is going to become apparent very shortly. So it's a time to be fully aware of everything that's happening in markets, particularly with the Danielcode, which will make sure you are the right way. So here's sort of some of the questions. The biggest bull market in history will only end when the Danielcode ends it. Historically, we can see that with all the major turns. The dot-com high in 2000, the S&P high before its 2007, 2009 crash, the COVID flash crash, the high 2022 high, and where we're sitting right now. So human nature is such, though, that we always try to ascribe a reason. We want to have a reason. And, the reason that talking heads exist, the reason that print media, radio all exist, is because as far as market participants are concerned, there is this general belief that the experts, quote unquote, have some idea of what they're talking about, and that's not really true. What the expert's real job is to try and take whatever the market for, whether it's precious metals, whether it's commodities, whether it's bonds, equities, anything, is to try and take the recent price action and try and ascribe a reason for it that the great unwashed out there, the public, will understand. And their forecasting skills are lamentable. But nevertheless, it's a common belief, and millions of people log on to watch Squawk Box, to read Bloomberg, and of course also to read those who are a bit more interested in markets, to read Zero Hedge, which is still a wonderful publication. For some of the stories that the mainstream media either don't get or don't want to get. So they're all sources of information. Some are useful, most are not. So human nature being inquisitive, we always need to find simpler reasons and explanations. So let me tell you, just to have a full disclosure, by nature, I am a perma-bear. I believe that everything is too expensive. I believe that inflation's running at least 3 times the officially recognized and reported results of inflation. I believe that the Fed has designed its tools that it uses to measure inflation, and it's quite open about it. It uses a measure of inflation that gets rid of the most volatile price movements. Food, certainly. Geek, who may or may not be with us today, I haven't got around to looking for that, said that interest rates were not included in the Fed's official figures for inflation, nor is transport costs, petrol, diesel, whatever else, electricity. And so that's my basic premise. However, over the years, what I've learned is that stay close to the market, follow the Danielcode signals, and you will always be the right side of the market. So at the moment, our Danielcode's holding us in suspense. But as I say, some clues are starting to appear. And I think that the likeliest reason for an end to this historic bull market in equities is a significant credit event, too much lending, plus fraud, and the dangers of hypothecation. Now, for those of you who are old enough, cast your minds back to 2007. As the equities market was topping, all the experts were saying there's not a problem. As the market started to move along and some of the crazy credit events that had happened were starting to come to life, the commentary was, even from the Bernanke, the governor of the Fed at the time, oh, it's an isolated thing. It's quarantined. It's not going to spread to other markets. Well, this is what leads us to the question of cockroaches. And the important thing to remember about cockroaches, and you've heard this, no doubt, many times before, there's never just one cockroach. So that's a warning that if we are seeing significant events, we ought to at least consider the probability that there are not just more cockroaches, but maybe many, many more cockroaches. And I think given what's been happening in the run-up in this massive, wonderful, exciting bull market, historic bull market in equities, which has now been taken on by gold and silver as well, is just how amazingly resilient these markets have been. And of course, the stronger the market, the more it's going to take to stop it. And what's going to stop this market? Well, you'll see as we go on some of the probabilities, at least, as to where we could see some problems. Now, for those of you who don't follow financial market commentary much, you'll see that word I've used, hypothecation. And hypothecation is basically a description, or if you like, a definition of what happens with securities that typically, if you're borrowing money, you may be asked to put up security. Everyone knows how mortgages work. You borrow money, the bank gets a charge over your property, of whatever sort it is that you're offering. The problem with hypothecation is that that security can then be used again. In other words, you have your mortgage, you borrow money from the bank, you think you owe money to the bank, but you may not, because they may have sold that document, that contract, to someone else, who may have then sold it to someone else, who may have parceled it up with a whole lot of other promises to pay and got a credit rating for it. And that was, of course, what finished up blowing up the equities market in 2007. So hypothecation is a real and present danger. And we're starting to see some of the damage from that now. One of the questions that has not ever had a satisfactory answer is why are central banks buying so much gold? You know, this whole gold rush has been, that's what it is, it's a gold rush, has been fantastic for traders in particular. If you look at a market like this week's trading, honestly, it was all just up and down pretty much, except for gold and silver. And, you know, your gold trade covered a lot of sins. It's made 24,000 for one contract just on its last little run up since it elected its flip me buy signal some period ago. And in fact, if you go on the Danielcode website and click on the link to flip me, I haven't updated it for a couple of weeks, but you'll see the last gold chart under our flip me banner showed you exactly where the flip me buy signal was for gold, which has since then, as I say, run up to $24,000 per one contract. Pretty good stuff. So we've now got the market at historic highs. All of the equity markets are at historic highs. Dow, Russell, NASDAQ, S&P, all the ones we cover, and Germany's DAX, not so much. But all the US markets are at all-time highs, historic highs. And we have this concerted push. I've got in there conceited push. Maybe that was a unintentional slip of the tongue. Because all the experts are pushing for lower official rates, starting with the fearless leader of America, President Trump, who's a real estate guy basically, so they always want lower interest rates. But we have this concerted push for lower official rates with markets near all-time highs, and that's a bit counterintuitive. Reducing interest rates is a method of stimulating the market. Well, the last thing our equities markets need is any stimulation. They've had tons of it, most of it coming from the narrative. And the narrative is a very important part of what drives equity markets. And the narrative is AI, artificial intelligence, which is, in my view, a complete misnomer. There is no such thing as artificial intelligence. And really, what all this wonderful AI is a function of the ingenuity and genius of coders combined with the turbocharged development of the chips that are the driving power of all of these tools that you see in financial markets. And the basis that I say that is that artificial intelligence, if you think about it, it's actually Google on steroids. It's a question and answer type library, and it's just got so sophisticated, as I say, with the genius of programmers and the availability of ever better chips, which is what they use to make these programs run, that it looks like artificial, it looks like AI. And there's the old saying to primitive people who haven't had a lot of exposure to the Western world, technology looks like magic. And that's an expression that really started around 2000 with the great push for eyeballs, the rush to collect eyeballs as the then all-time high in the Nasdaq was being made. So a little bit of counterbalancing there between normal economic approach at market highs would be that as the market gets higher, more frothy, higher price, you expect interest rates to be gradually increasing or stable, and that you would have some buffer there to reduce interest rates if there are problems in the wider economy that need some stimulation. And it's not apparent that we have any of that at the moment, yet the push goes on. So today, there's a whole lot of writing in the next couple of pages, next couple of slides, folks. And I wanted you to take an opportunity to read this. This is from Zero Hedge. You can find them on Google and start to read them. And they're very, very good at reporting some financial matters that don't get a lot of space in the normal press. And you have to remember, of course, that the commercial press is slanted, skewed to please the people who are paying for it, which are basically advertisers. So financial websites, papers, podcasts, etc., by their nature, they tend to always be bullish. They don't want to tell you about the other side of the transactions. But this is an interesting one because a couple of weeks ago we had a bit of a blow up with the huge auto dealing company. Here it is, First Brands. You can see they blew up, and as they've been looking into it, they find that there's been a number of cases of hypothecation where the security they thought they had it wasn't there. It had either been sold off, and you can see when you get just to the second para there, he's saying quite rightly, if JP Morgan has a loan problem with Tricolor, it's puny. An analyst at Wells Fargo said, if smaller banks have those problems with these loans, it takes more of a hit. And excuse me. In this case, there are allegations of large scale fraud in this private credit market. And there's not much talk about the private credit market, and that's been a huge, huge growth area in recent years. And you look at the final paragraph, California Bank and Trust provided 2 revolving credit facilities in 2016 and 17, involving more than 60 million. The security basically was mortgage loans, and then they've since found out many of the notes and underlying properties have been transferred to other entities, and those properties have already been foreclosed on or were about to be, according to the lawsuit. So, hypothecation, danger, credit. I think myself that what will eventually end this historic bull market is a credit event, and this could be the sort of thing that could grow. And I'm sure at this stage, everyone says, no, it's quarantined, it's not going to affect anyone else. And of course, we've heard all that many times before. And here we are. This is a bit of the technical stuff about it. But you should read this whole article. It's important because I think it's underlying a future problem, which we'll come to. As Buffett famously says, everyone looks good when the markets are going up, but you find out who's been swimming naked when markets go down. And I think we're closer to that stage than we have been for many, many years. And you can do read this. It's at zero hedge, and I think it's important stuff. So let's find out what actually the markets are doing. Well, this is an oldie and a goodie that I show you periodically, and I tell you that the easiest trade you can have is to look for a reversal of the S&P and or silver. They're the two markets that are most susceptible to the moon, and you can see it's hard to see because it's yellow on a white background, but you can see that we had a pretty much perfect moon shot one day after the high, the all-time high, and this is the Dow, which we don't talk about much, but there it is. Okay, so there was your nice signal from the moon, and let's see what else we've got that's going to be a bit more telling for you. And I want to just show you the 6-day chart of the major markets we're interested in. These charts, every bar is created of 6 trading days, and what you would expect is that since we're going over a longer time frame, you would expect that the price or target recognition of these markets would be considerably less than you would see on the daily charts. And these blue lines are Danielcode extensions of previous ranges, and the red and black lines you see below the market, they're corrections from the existing swing high or other swing highs or lows, as the case might be. And you can see that on this 6-day chart, we had target recognition 1 tick variance, and by that I mean the price at the high compared to the number in the blue line, which and these blue line numbers have been on these charts for weeks and weeks, sometimes for many months before they get reached. But you can see the closing high of this market, that's the completed bar that's got the highest close on it. That occurred 2 or 3 weeks ago with just 1 tick variance. 1 tick, it's like nothing, not even a human hair. That's how accurate these charts are. So from there we had our nice big reaction down, which we enjoyed trading last Friday. For those of you who've done Danielcode tutorials, you will hear my words ringing in your ears that when we get these super massive bars, put your trailing stop on and protect your profits, which was the smart thing to be doing towards the close of Friday. And since then, pretty much nothing. It's range trading. And there are 2 simple explanations for this. And of course, one is a contradiction of the other. Either this market is girding its loins to recover that pretty minor sell-off that it had last week, and there's the bullish interpretation. The bearish interpretation is all the smart money is loading up their shorts and their puts, and we can look forward to an extended move down. What's the answer? Still a coin toss at the moment. So that was S&P. Here's gold, and this is despite what Mr. Peter Schiff would argue, and he argues vehemently, that gold is not a commodity, it's a precious metal. Well, it's both. It is a commodity, as is silver. But look how accurately this market can track its Danielcode numbers. You're in this case, this is a historic blow off. Is it the blow off top? It probably ends with being, it must end at some stage. Being a blow off top is the likeliest way for commodities to finish important market moves. But you can see how it's run through those red lines, run through the blue lines, I should say, as this rally keeps accelerating upwards. Look how accurate it is. It's just absolutely hitting these numbers. Every single bar, you can see the close today, right on that 43, 45 number, the close for the last period, 6-day period, right on that 41.65 number with just a couple of ticks variance. It's incredible stuff. But this is the makings of a blow-off top. I'm not telling you this market's about to stop. The central bank buying of gold has really put a floor on, and in fact, it's a sliding floor. It's going up and up and up. It's more like an escalator, isn't it? So that's what's happening there. And this is US T-bonds, and this is a very important chart for us. Again, you can see how accurate this thing is on the 6-day chart. It shouldn't be this accurate, but it is. And we've had for the 3 of the recent highs, we've had 0 variance from target, 2 tick variance from target, and 1 tick variance from target. And today's close pretty much on target, around 118, correct 24. Those little arrows you see, those little arrowheads you see on bonds and on the grains. The proper word for that is a correct, C-A-R-E-T. So you can see how perfect your target recognition is on these 6-day charts. Those are organized markets. That's how they work. And what's been stunning is on this latest move on the S&P, we've had a whole lot of daily bars not finding their Danielcode numbers. And that's very unusual. And you can think about that when you look at the charts, which will be updated Friday night. You'll see them. They're posted Sunday, sometime very early Monday. Have a look at this, and I've just headed this warning, the famous Danielcode black line. This black line is 89%, and it's the last level of support or resistance for any swing in any market. You can see the black line here, which is a retracement of the last major swing, was sitting at 57.69, and today we have a close below that. In fact, the market's closed, it skipped the blue line there and it went to the next one, which is 56.92, and the close today was very close to 56.92, and I'll tell you exactly what it was. Here we are, today's close. I'll skip through this, skip through there. Where's today's close? 56.95. Three ticks variance on a 6-day chart. Pretty extraordinary, isn't it? I publish these 6-day charts for the 4 markets: crude oil, S&P, gold, and T-bonds, twice weekly, more often if necessary. And you can subscribe to that. I have found them an enormous help. And as well as that, their accuracy has been absolutely uncanny, as you can see with what I've been showing you. So the warning comes from the fact that close below that black line moves the odds massively in favor of the probability that the swing low will be taken out. And that's a pretty sensitive spot in the oil market. If that happens, it will be... the probabilities now from the close, the 6-day chart finished today, that particular bar finished today. So that close below that black line in crude oil moves the odds massively towards the probability that that very important swing low will be taken out. So what's that do for you? What are you thinking about with that? Well, what it's telling you, apart from anything else, is that demand in the oil market is weak. If we've got equity markets at all-time highs, wouldn't you logically think the world will be needing more oil? That's a great source of most goods, not technology, but everything else. Oil, most common form of power, together with coal. There should be great demand to match this amazing economic activity of production. That is what the equities market is telling us. But oil is telling us no, and it's giving us a warning it might get worse. So I've moved on now to our 24-day chart, which is the basis of our time cycles. Now, let me make it clear to you that I do these time cycles on a limited basis only for my own interest. The Danielcode 4th seal, to which you can subscribe, it gives you excuse me, the 6-day, 12-day, and 24-day charts and commentary, which is prepared for you by our resident guru, Frank DB, or Frank de Bayer. He's a wonderful young man. He came to me in 2011 to a live tutorial I was running in Taupo, New Zealand, one of the most beautiful places you'll ever see in your life. He was a very young man at that time. He's still a young man, but this was back in 2011. And he brought his fiancée, Anne, with him. They're now married. They have at least 2 children that I know of. How wonderful. And he said to me, I've never seen a financial market chart, don't know anything about it, but I like your articles. I used to do a lot of articles for Financial Sense and Forex Journal, etc. Frank came to me and said, will you teach me? And I did. And that was the first year. I very, very rarely teach the 4th seal. And I haven't taught it for many years now. But I taught it at that particular tutorial, and that the 4th seal is our forecasting of time cycles. And it's been pretty fantastic, as those of you who've been with us a long time will know. Frank then went away for a few years and eventually contacted me and said, you know, I've devoted the last 3 or 4 years to just understanding how the Danielcode 4th seal works and how it attacks forecasting. And I'd like to do the commentary for you. And he's been doing that ever since. And he's very, very good at it, let me tell you. So you should subscribe to the 4th seal if you'd like to have a more detailed understanding of how and why markets turn, and more importantly, where. Well, as you can see here, we are still at charts that the previous bar, this is a 24-day chart, so each of these bars is created with 24 individual trading days. And you can see that we've got a marginally higher high on the current bar, which has got quite a way to go before it matures. And so let me tell you how long that's going to be. Here we are. Equities. That current bar on the 24-day chart is going to end on November the 5th. November the 5th. Yep. November the 5th will see the ending. The end of that bar that is the current bar on the chart, November the 5th. But at the moment, the bar before that, the bar that ended in October, is giving us the closing high. Now, remember these long-term charts, they can be valid on either the bar high-low or the closing high or closing low, as the case might be. So we're still in that 62 cycle, which is a sort of a sneaky one. I talked about it at our last webinar. That's the alternate to the 59 cycle, which is traditionally the dominant cycle in equity markets and in gold. At this stage, this frees the market right where we are today. The closing high came in that October bar, which was at the 62 cycle, which I would say is the sneaky alternate. It doesn't appear very often in markets. 59 is the dominant cycle, but now and again it slips through, and if it does, it will land on the 62 cycle. Don't be confused with anything to do with Fibonacci. It is not 61.8. It is actually 62, 62 and a half. And that's the alternate to the 59 cycle. So the other job of markets, I say, get great unwashed wrong. And even some of us who are partly washed wrong if we're too dogmatic about things. But what we can say is that this market is in the time frame for a very, very important top. And once we get a top in place, and the first confirmation would be a close below the swing low of the 6-day chart, which I've shown you, we'll then be able to forecast where that particular correction is going to go. It might be a minor correction. It may be the final correction of this historic bull market. And there's a couple of historic events coming up that may leave the basis for that. So you can see we're still in that time frame there. This is gold, and I want to just show you the makings of a blow-off top. It doesn't mean that's happening imminently. I haven't updated my forecast on gold, but you can read Frank DB's forecast on the Danielcode fourth seal. You can subscribe to that. He does it Monday every week, and he gives a commentary with it. It's very, very good stuff, very important. So here's gold on its way to a blow-off top, I suspect. Here's silver, which, as you can see, I've been showing you for a number of weeks, is just running up some accelerated trend lines, and it's had a massive last week or two, just roaring along, and is good stuff. So here's Bitcoin, and of course it's had a monster run. It's down a bit from its all-time high, but it's been a sensational trip, and that's exciting a lot of investors and a whole lot of people, and probably exciting people who are not fully cognizant of this chart. And this chart is my long-term chart in UST bonds, which I've been running since about 2000, and you can see it's got a whole lot of time cycles on it. Most of which are pretty interesting. And the diagonal red line running across this chart is the Danielcode trading channel on the 24-day chart. And you can see the lines, the dotted lines above the solid red line and below the solid red line. Those are deviations, standard deviations from the mean. What we've done on this chart, instead of using standard deviation, which is 1, that's the normal mathematical expression, we're using Danielcode deviation. So we're using 1.593 plus or minus as it runs up or down. And you can see how incredibly accurate those price levels have been, because, as I say, we stopped moving that Danielcode trading channel in November 2016. So all of those dotted lines since then have simply been created as an extension of where the diagonal line was. And you can see at the recent lows down here, that support is 6 Danielcode deviations from the mean, which is massive, and it would make no sense at all unless you understood that the high came at 1, 2, 3, 4 deviations, 1, 2, 3 deviations from the mean. You would have expected 3 deviations below the mean, and after that is the extension that just got itself running. And we tracked that move all the way down. Greg Young's not with us today. He sent his apologies. He's got some other obligations, as has Mark L. And you can see that where this market has bottomed is right on that extension, that dotted red line, 6 Danielcode deviations from the mean. And it's been battling to hold that now for 1, 2, 3, 4, 5, 6 months. Basically, the 24-day chart is the Danielcode monthly chart, if you like. Most months have 22 trading days, so it's an approximation of that, but it's an accurate representation of Danielcode time. And that low, which was sitting right on the red line, we've had I would say, a modest rally since then. And what happens to that market is going to be crucial in the game going forward. So this is a slightly clearer version of that. And what I want to show you is that that low 4 months ago came at almost exactly the same price as the disastrous crash low in 2000, which was caused by massive unchecked inflation. And Paul Volcker was then the US Fed governor, and he'd been raising rates to try and counter inflation all the way up to 8-9%, a massive, unheard of level for the Fed. Eventually, he said, "It's not doing the job. I'll make sure I kill this inflation." And what he did is he then raised official Fed interest rates to 12%, and a few days later, 22%. And that break, you can see on this chart where the green line is, the vertical green line, that's what happened when we got the break, Volcker's break from about 8 or 9% interest, maybe a bit less than that, all the way down to February 2000, after he raised interest rates to 22%. And if you look across where that market was, where the bonds market was at its recent low on the 6 deviation extended dotted line, was exactly where T-bonds were before Volcker finished up crashing them completely. And that low on the bar prior to the move to 22% was 110 correct 12. Have a look at that low. We had the low on the red line. It's not the ultimate low, but it is on a angular chart. We can have lateral charts and angular charts, which will have different lows. The October 23 low was actually lower, but the low that we're looking at right on the top, the down move for the time being at least, was 110 correct 1. So just a handful of ticks, 2 handfuls of ticks away from the low back in 2000. And that is still, in my view, perilous stuff. So what's actually happening here? Gold, massive, unbelievable, wonderful bull run. It has limited supply and real cost to produce it. Silver has limited supply and real cost to produce it on a massive bull run. Bitcoin has not only limited supply, it has a real cost to produce, but also a defined hard limit. In the architecture of Bitcoin, there's a hard limit beyond which there will be no more Bitcoin. And they're the markets that are in these historic bull markets. The whole world has worked out that with limited supply, other things being equal and a bit of boosting involved, you can get these massive moves that we're seeing in these markets. In fact, think about it, gold and silver and US equities, they're the prime source of funding and all traders. There's been a lot of chatter about that lately. So, tariffs. Think about tariffs. I talked to you about this at our last webinar. It's set down for hearing by SCOTUS, the Supreme Court of the United States, on 5th November, which is not far away, is it, folks? It's just a few weeks. And opinions will be formed already, but there'll be more opinions formed after the hearing has taken place, because it's run in open court. You can hear the arguments pro and con, and more importantly, you can hear what the judges have to say, and sometimes you'll get a bit of an idea about which way they're going to lean. I have told you I'm a lawyer. I've been a lawyer for longer than I wish to remember, so I'm a very old lawyer. But I can tell you that to any lawyer in the Western world with traditional legal training, they understand that tariffs are a tax. By definition, they're a tax. And under the US Constitution, taxing and spending powers are reserved to the US Congress. They're not delegated per se to the president. Traditionally, there have been occasions when the Congress has devolved, if you like, its tariff rights to the president of the time, Nixon is an example. And when that's been done, it's for limited purposes and very limited time. And that's not how Trump is wishing, hoping, guessing that the way tariff works is likely to work. So, yeah, you can understand that I'm giving you the legal version. I believe that it is almost inevitable that the court is going to hold that Trump's method of imposing tariffs throughout the world, pretty much, with different levels and different reasoning, is unconstitutional. And this court case that's going to come on is really a much bigger question even than tariffs. It's a basic understanding of the US Constitution, how federalism works, and the separation of powers between the judiciary, the legislature, and the executive. They're the three bastions of power under the US Constitution. So, if they are likely to find that all these tariffs have been unconstitutional, that's not entirely the end of it. There are other methods that the president can use to create tariffs, but none of them are in the form of the tariff that we're now seeing. And if you think a little bit about Trump's time as president, POTUS, President of the United States, it's largely been an exercise in avoiding involvement with the Congress. He's got his big bill, the big beautiful bill, so-called, through. He got that through the House of Reps and then confirmed by the Senate. But by and large, all of these other matters is just running the Constitution, running the country on an endless series of presidential decrees, if you like, some of which are valid and some of which are undoubtedly unconstitutional. But it's a problem that I should start by saying it's been a very, very clever thing that Navarro has done, that Trump's economic advisor, Peter Navarro, who actually served jail time over his refusal to acknowledge that there was an act of insurrection after the previous, at the end, I should say, of the previous Trump administration. Anyway, you don't want to get involved in that other than to say it's a very, very clever method of taxing the US, parts of the US population. And of course, who pays this? Well, at the moment, you're not seeing much of the benefit of it, or the cost benefit of it, because the suppliers of goods, and some even extending, trying to attach to services, but essentially attached to goods, the people who pay that are basically the importer. So all those kids' toys that come from China, so people at the end buy it because that cost is going to get passed on. By and large, most of the big importers of all sorts of goods, other than steel, of course, which is a separate category, motor vehicles, have absorbed a large part of the tariff. So the full cost impact of the tariff has not been felt yet. If the court rules that it is unconstitutional, the US Treasury is going to have to refund billions and billions and billions of dollars. And then we'll sit through the next generation of tariffs, because Trump certainly will have another 1 or 2 or 100 ideas crossing his mind. So is this going to be a problem? Well, is this another cockroach? If it is, it's a biggie. The amounts of money involved are massive. I've already, I think, said that it's the best and only effort we've ever seen, realistic effort, to get the country's debt burden under control. And it's a tax, but it's a tax that's distributed widely, so it's not entirely slap it in your face noticeable. That may become more apparent if these tariffs are ruled to be constitutional So the vendors who are having $1 each way are going to have to make the decision to pass on those costs. So that's something to be really thinking about. 5th of November, and it's a biggie. It's a biggie. Okay, let's move on. And time is moving. So with its equities narrative, there are two basic measures that have pushed the price of stocks. There's the narrative, which is the consensus view favoured heavily by the major brokerage firms. And the one that's been running and is still dominant now is AI. This is going to be so positive for businesses. It's going to reduce their labour costs immensely. It's going to automate so much of what they're been doing and employing people for. So AI is really a big destroyer of jobs as much as anything else. But that's all coming down the pipeline. And for stocks prices, we're certainly looking at a perfect storm. Much can go wrong, and credit events are the big overhang because they take so much time to develop. Remember that regional bank issue I've been talking to you about? We talked about the events that are happening now, but this all started in 2016 and 2017. And it's taken all this time for it to become apparent. So that's a very dangerous form of cockroach. They're sneaky little buggers and they can hide terribly well. Okay, what I've done is I just want to show you beyond masterclass our momentum method that forecasts the ability of markets to trend. As you can see, there's been one momentum sell signal completed back in September this year. And since then, nothing but momentum buy signals. And that big bar down that we had on Friday has not of itself created a completed momentum signal. It is bar one of a momentum signal, but at this stage it is not completed. And it's running out of time. It's 1, 2, 3, 4, 5 from the swing high. At 7, I bail out. Doesn't mean it's not going to happen, but it's very unlikely to happen. Confirmed momentum signals, or Momo bars as I call them, that come early are the best. And this is not going to come early. It may not come at all. This market could rally from here. But there's certainly no momentum bar created so far. Here's the NASDAQ, exactly the same. You've got the first of the momentum bars. At this stage, it is being rejected by the market. Okay? The momentum bar is being rejected by the market. Right. So, teach yourself to trade. This is those of you who are interested in learning some of this stuff, or all of this stuff if you'd like. Our new TTT, they're short videos, and they will teach you everything that you see me doing at these webinars and more as well. And here are 4 videos that are on the front page of our website. I do really encourage you to take half an hour out of your time and watch one of them. Video 1 is Mark L. Videos 2 and 4 are Justin, who both these gentlemen have done so much to share their knowledge of Danielcode tutorials with our public. So here it is. You can click on that TTT link. It'll tell you what's in the videos, and just email me, jneedham@thedanielcode.com, if you need any more information, or otherwise if I can be of assistance to you. So what have we been doing this week? Well, basically a couple of nice markets, but the most of them have just been getting pushed back and forward. This is oil, and we had a nice push down on a T.03 sell signal. A couple of days little rally, then this next leg down, and we're sitting on about $4,000 for the current success trade. Here's the S&P. Huge, big down bar, as you can see. That was a result of the T.03 and Blue line sell signal the day before the high. Those signals are valid for 3 days, including the day they're posted. And you can see nice big sell-off there, very weak. rally from there. Most important part here is this particular rally, and including the big down move. The big down move, until then, this market had been tracking its Danielcode numbers perfectly. That shows us a highly organized market. It did not do much on that down move, except bounce off a bit of space, and it tried to close near the 6,600 blue line number. Apart from that, the next two bars found that blue line of support, and yesterday's high just burst straight through the 74% retracement, showing again it's disorganized. Today's low went and targeted the red line there from the high. So that's we're looking a little bit healthier in terms of the market's organization. So this is gold. This is a highly organized market. You can see it burst through its flip me signal back then. And this trade to date, just one contract in gold, is sitting at $25,000. A lot of traders talk about how just fabulous these moves in gold have been. And in fact, as I say, I haven't updated the flip me signal since then. I don't do them all the time, but trying to get you to think about flip me and what it is and how to use it. But if you go to the flip me tab at our website, you can see the flip me arrow and the number where you would have got long on a flip me signal. And from there, we closed today at plus $25,000 plus per one contract. Perfectly at Danielcode numbers, the same as organized market. Here's copper. It's just finding its feet now after it got absolutely whacked by Trump declaring he was going to put on Trump the tariffs, and then a very quick taco or takeover, whichever you use, to say no, they're not putting those tariffs on. So it's had a roller coaster bit of time. So we had a sell signal. We're short. Not much is happening to the downside. Pretty typical of all these markets. Here's natural gas. That kept a pretty nice sell, success sell against the black line. Down it went, $33,000 per one contract. Little counter trend rally, which was a fail, and then it continued to go down. I've been talking to you a lot in recent webinars about day trading, that I've been teaching my son how to trade, and as a result of that, I've gone back to day trading. And Lockie, a long time Danielcode friend, has sent me a note saying, talking about day trading, are you aware of all of these prop firms? They're called prop firms. For some reason, I don't understand. They're not proprietary, but I guess they latched onto that word anyway. And they're everywhere on the internet. Just look up funding, futures funding, forex funding, or prop firms, and there's a host of them. And what they're offering is come and join us, pay a very modest fee, and show us that you can trade, show us your results on a make-believe chart and trading, and if you can show us that you're a competent trader and you can make profits, we'll fund you. We'll put up the money, 50,000, 100,000, 400,000, million, couple of million if you like, if you're good enough. And for those of you who are aspiring traders, if you can prove, as I say, to these prop firms that you know how to trade, they will fund you. You don't need to put up capital. They will do it for you. Okay, so nice little trade on natural gas, little 1 bar counter trend, half a bar to the outside bar. When you look at that chart, the first thing you should be thinking about is the intraday trading, even as slow as a 1 day, as a one hour chart, I should say, gave you perfectly both the buy and the sell signals for that outside bar. Very nice if you knew what you were doing. Here's NASDAQ, same thing, big sell-off on our T.03 and a blue line sell signal. It was just a T.03 signal, not a blue line signal for the NASDAQ. Down it went, and it's been a rally against the buy signal since then. Success and correlated sell today. Down it went and then rallied hard from the low. no conviction in that sell side on that market at the moment. Here's the Russell, which I've been telling you for a long time is the best trading of equities. You can see how beautifully defined its sell signals and buy signals are. And it's choppy. It's all choppy, but it's a lot clearer than the other equities. Here's soybeans, nice little sell trade off it, and then the buy trade straight up. Today looked like it was going to be a nice day, and it rallied, it pulled back from that high in a screaming hurry in the last few minutes of trading today. Here's silver, which continues its rush. On and on it goes. It's wonderful. $24,000 per one contract in silver. As I say, lots of traders talking about how wonderful the gold and silver trades have been. And you should have been in one of them, not both because they're so highly correlated. But honestly, it's just been a godsend, as the other markets have not, with a few exceptions, have not been so rewarding. Here's UST bonds. That had 1.5 days down, flipped me by on the same basis as the gold flipped me by, hit the same place there. Off it went, nice big run up, and new high for this current move today. So if you haven't already, folks, do help yourself to a free trial. Go to www.thedanielcode.com, start your free trial. Just hit the register button. Any problems, contact Terry at the support of the Daniel Code. This here is our disclaimer. It is a warning to all of you. If you don't know how to trade, do not use real money. In fact, it's very easy to lose money trading if you don't know what you're doing. The good news is it's equally easy to make money once you do know what you're doing. So get yourself educated. Make sure you learn from someone who understands the markets. The easiest way for you to become a proficient trader is to undertake the Daniel Code tutorials, and you will be in knowledge of everything. Okay, so that's about me for the day, folks. I hope you've enjoyed our little chat. Do be at a high state of awareness and caution. If this thing breaks right now, it could do so very rapidly. Watch the Daniel Code signals. The daily signals will get you the right way. I don't think we've ever missed a big move, so we're not going to start now. Okay. Something that I don't catch the recording. Yeah, great pleasure, Lottie. The recording will be posted by Terry tomorrow. So that's me for the tutorial and for the week. It's a beautiful sunny Friday down here. It's a gorgeous day. Blue skies, gentle wind, it's warm, not hot, it's just about perfectly perfect. And that's, they say, isn't it perfect, but beautiful one day, perfect the next. I think that's another Kiwi expression that's been poached, but there we are. So that's it, folks. Enjoy your trading and be on high alert. Things can get very dramatic very quickly, perhaps very soon. Bye-bye for now.